Behavioral finance is an area of study that examines how psychological factors and cognitive biases influence financial decision-making and market outcomes. Unlike traditional finance, which assumes that individuals are rational actors who make decisions based on complete information and logical reasoning, behavioral finance acknowledges that human behavior often deviates from rationality due to emotional and psychological influences. This approach offers valuable insights into why markets can be inefficient, why investors may make irrational choices, and how these factors impact financial markets and investment strategies. Before starting, don't forget to like and subscribe to our channel for more future updates. Core concepts in behavioral finance: heuristics and biases. Behavioral finance identifies various heuristics and biases that affect decision-making. Heuristics are mental shortcuts that simplify decision-making processes, but they can lead to systematic errors or biases. Heuristics and biases include anchoring. Anchoring occurs when individuals rely too heavily on an initial piece of information, the anchor, when making decisions. For example, an investor might anchor their perception of a stock's value to its historical price, even if current market conditions suggest a different valuation. Overconfidence bias. Overconfidence bias leads individuals to overestimate their knowledge, abilities, and the accuracy of their predictions. Investors might believe they can consistently outperform the market, leading to excessive trading and risk-taking. Confirmation bias. Confirmation bias involves seeking out information that confirms existing beliefs while ignoring contradictory evidence. Investors may focus on news or data that supports their investment thesis and disregard information that challenges it. Loss aversion. Loss aversion is the tendency to prefer avoiding losses over acquiring equivalent gains. Research by Daniel Kahneman and Amos Tversky shows that losses are psychologically more impactful than gains of the same size, leading to risk-averse behavior. Herd behavior. Herd behavior occurs when individuals follow the actions of a larger group, often leading to market bubbles or crashes. Investors might buy or sell assets based on the behavior of others rather than their own analysis, contributing to market volatility. Emotional and cognitive factors. Behavioral finance explores how emotions and cognitive processes influence financial decisions. Emotional investing. Emotions such as fear, greed, and excitement can drive investment decisions, leading to irrational behavior. For instance, during a market rally, investors may feel euphoric and make overly aggressive investments, while during a downturn, fear can lead to panic selling. Mental accounting. Mental accounting refers to the tendency to categorize and treat money differently depending on its source or intended use. Investors might treat gains from a stock market investment differently from money earned through other means, leading to inconsistent decision-making. Framing effects. The way information is presented, or framed, can significantly impact decision-making. For example, investors may react differently to the same piece of information depending on whether it is presented as a potential gain or a potential loss. Impact on investment behavior. Market inefficiencies. Behavioral finance explains why markets are not always efficient, contrary to the efficient market hypothesis, EMH. EMH posits that asset prices always reflect all available information, making it impossible to consistently achieve higher returns through stock picking or market timing. However, behavioral finance suggests that cognitive biases and emotional factors can lead to mispricing of assets and market anomalies. Asset bubbles and crashes. Behavioral biases can contribute to the formation of asset bubbles, where prices become inflated beyond their intrinsic value due to excessive optimism and speculation. Conversely, market crashes can occur when fear and panic lead to a sudden and severe decline in asset prices. Excessive volatility. Investors' reactions to news and events can cause excessive volatility in financial markets. For example, overreaction to short-term news can lead to sharp price swings that do not reflect the underlying fundamentals of the assets. Investment strategies and performance. Behavioral finance has implications for investment strategies and performance. Understanding behavioral biases can help investors make more informed decisions and develop strategies to mitigate their effects. Contrarian investing. Contrarian investors take positions opposite to prevailing market trends, often capitalizing on market overreactions driven by emotional factors. By recognizing when the market is excessively optimistic or pessimistic, contrarians can identify opportunities for value investments. Long-term investing. Behavioral finance suggests that adopting a long-term investment horizon can help mitigate the impact of short-term emotional reactions and market fluctuations. Long-term investing allows investors to focus on the fundamental value of assets and avoid being swayed by temporary market noise. Diversification and risk management. Behavioral biases, such as overconfidence and loss aversion, can lead to suboptimal risk-taking. Diversification and disciplined risk management can help investors avoid concentrating their investments in a few assets or sectors and manage the impact of cognitive biases on their portfolios. Behavioral finance and financial markets. Behavioral finance in asset pricing. Behavioral finance has influenced asset pricing models and theories, challenging traditional approaches based solely on rational expectations. Some notable contributions include prospect theory, developed by Daniel Kahneman and Amos Tversky. Prospect theory provides an alternative to traditional utility theory by incorporating psychological factors such as loss aversion and reference points. It explains how people value potential gains and losses differently, affecting their decision-making under uncertainty. Behavioral asset pricing models. Behavioral asset pricing models integrate psychological biases and heuristics into asset pricing theory. These models aim to account for anomalies such as excessive volatility, market inefficiencies, and deviations from rational pricing. Impact on financial regulation. Behavioral finance has implications for financial regulation and policy making. Understanding behavioral biases can inform regulatory measures designed to protect investors and promote market stability. Investor protection. Regulators can develop policies to protect investors from common biases, such as requiring clear and transparent disclosure of investment risks and ensuring that financial products are suitable for individual investors' needs and risk profiles. Market regulation. Behavioral finance insights can inform market regulation by addressing issues related to market manipulation, misinformation, and excessive speculation. Regulations that promote transparency, fairness, and accountability can help mitigate the impact of cognitive biases on market behavior. Applications of behavioral finance. Behavioral finance in wealth management. Wealth managers and financial advisors can apply behavioral finance principles to improve client outcomes and enhance financial planning. Behavioral coaching. Advisors can use behavioral coaching techniques to help clients recognize and overcome biases that may affect their investment decisions. By educating clients about common biases and providing strategies to manage them, advisors can improve clients' financial decision-making and investment outcomes. Personalized investment strategies. Behavioral finance insights can inform the development of personalized investment strategies that align with clients' goals, risk tolerance, and behavioral tendencies. Customized approaches can address individual biases and preferences, leading to more effective financial planning. Behavioral finance in corporate finance. Behavioral finance also has implications for corporate finance and business decision-making. Corporate governance. Understanding behavioral biases can inform corporate governance practices, including board decision-making and executive compensation. Addressing biases in governance processes can lead to more effective and objective decision-making. Capital budgeting. Behavioral finance insights can be applied to capital budgeting decisions, helping companies assess investment opportunities and manage risks more effectively. By recognizing and mitigating biases in project evaluation and selection, firms can improve their capital allocation strategies. Challenges and criticisms. Complexity and measurement issues. Behavioral finance faces challenges related to the complexity of human behavior and the difficulty of measuring biases and their effects. Psychological biases are often subtle and context-dependent, making them challenging to quantify and incorporate into financial models. Integration with traditional finance. Integrating behavioral finance insights with traditional finance theories remains a work in progress. While behavioral finance offers valuable perspectives, it is essential to reconcile its findings with established financial models and theories to develop a comprehensive understanding of market behavior and investment decision-making. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.